Hi class, Professor Harrison here. In this video I'm going to go through how to use two balance sheets and an income statement to create a statement of cash flows. In this one, they're using the direct method. As with creating the statement of cash flows, there are four sections that we need to be concerned with. The first section is going to be the cash flow from operations. The second, cash flow from investing or from investing activities. Third, cash flow from financing or financing activities. Last, the reconciliation of the change in cash to the beginning cash and the ending cash. In getting started, first we're going to look at the cash flows from operating activities. The first line here is cash received from customers. The way that we get cash received from customers is first to assume that all sales happen on an accounts receivable basis. Then from accounts receivable, it's paid over to cash. So we start out with our sales number, which is $322,000. We then subtract the change in accounts receivable. The change, as you look at the balance sheet that I prepared, I have a column all the way off to the right, which shows the change between the previous year and the current year. All the way to the left, you'll see another column that says O, I, or F. And that stands for which section of the statement of cash flows that line item corresponds. O is for operations, I is for investing, F is for financing. The change in accounts receivable between the last year, the previous year, and the current year went up by $3,000. So we take our sales number, $322,000, we subtract that change in accounts receivable. This gives us cash received from customers, $319,000. We then look at the next line item. It says cash paid to suppliers. To get this, we start off with the cost of goods sold, $209,000. We subtract a change in accounts payable. Change in accounts payable was a negative $4,000. And we add a change in inventory. The change in inventory was also a negative $4,000. This, when we add and subtract appropriately, paid to suppliers, $209,000. Last, cash paid for selling, general, and administrative. Here we start with the SG&A expense, and the SG&A expense was $92,000. We subtract if there are any other liabilities, short-term liabilities that are not accounts payable. There are none. So we just carry over our selling, general, and administrative, $92,000. When we do the math, $319,000 minus $209,000 minus $92,000, the net cash flows from our operating activities, $18,000. Regardless of method, indirect or direct, we should end up with exactly the same number. Next, we move on to our cash flows from investing activities. This is where we would see changes in fixed assets, such as plant, property, and equipment, intangibles, or long-term investments. The only change is a sale of land, and that sale of land brought in a positive $8,000. That's our total for our cash flows from investing activities. Last, second to last, cash flows from financing activities. As we can see by the change in our balance sheet when it comes to bonds, we have far fewer bonds outstanding. That means the company retired bonds in the amount of $44,000. It did issue stock, and the way that we account for that is the line common stock plus the additional paid-in capital. For our purposes as financial analysts, we just add those two lines together. The net change there brought in $23,000. Last, we look at the change in the retained earnings. Adding the retained earnings to the previous year, noting that there's a slight difference, and that difference was a cash dividend that was paid, $2,000. The net change in our cash flows from financing activities was a cash outflow of $23,000. For the last section, we first calculate the net increase or decrease in cash. That would be our net change from operating activities, a positive $18,000, plus the cash flows from investing activities, a positive $8,000, minus the net outflow from financing activities of $23,000. The net change in cash was $3,000. We go back to our balance sheet and pull over the previous year, the beginning of the period's cash balance, which was $3,000. Adding those two together, we should have a cash ending balance of $6,000. That lines up with our cash for our current year of $6,000, and our statement of cash flows has adequately explained the change from the previous year to the current year in cash. Thanks for watching. I hope you found this video useful.